Hello everyone, and thanks for joining us today. My name is Cillian Barry and I'm a tax partner in KPMG Ireland. Today we plan to provide you with an update on the key international tax developments impacting businesses in Ireland, leading on from our webinar in January and our in-person event with the Minister for Finance in March. The pace of change in the tax world has been phenomenal in recent years, from the initial OECD BEPS process to the EU Anti-Tax Avoidance Directive and the Tax Cuts and Jobs Act in the US. There is certainly no rest in sight as the international tax agenda remains fully stacked in 2022. In this regard, the key focus continues to be the BEPS 2 process and primarily the Pillar 2 proposals. These proposals will fundamentally reform the global tax landscape. I'll kick off today's session by providing an update on the key developments in the BEPS 2 process over the past couple of months and what to expect over the remainder of 2022. I'm joined today by my colleague Anna Scally, who will discuss some of the key aspects for businesses arising from the Pillar 2 proposals, as well as some of the common issues that we are encountering to date when seeking to apply the Pillar 2 rules. Anna and I are delighted to be joined today by two of our leading international tax colleagues, Brett Weaver and Vino Kalu. Brett is a senior international tax partner with KPMG in the US and has advised many of the largest US technology groups on international tax matters. Among the many leadership roles Brett has had, he is the Head of Tax Transparency Services with KPMG US. Brett will provide us with an update on the prospects of US tax reform and US's approach to BEPS 2. He will also update us on the state of play with Pillar 1, where Brett has played a leading role in advocating for workable solutions in developing the Pillar 1 rules. Vino is KPMG's EMEA tax policy leader and a member of our global tax policy team. Vino is a former European Commission official and he will share insights with us on the current US tax landscape, including the BEPS 2 directive, the Shell directive and the DEBRA proposals. We will have a Q&A session at the end, and in that regard I'd encourage you to ask any questions you may have through the Q&A or chat functionality, which can be done anonymously. So let's get into the detail. A quick reminder of the basics and the acronyms that are now part of our lives. One of the great unanswered questions from the first Base Erosion and Profit Shifting, or BEPS, initiative run by the OECD was how to address the tax challenges arising from the digitalisation of the economy. The current proposals to address these challenges have become known as BEPS 2. To advance BEPS 2, over 130 jurisdictions agreed to a two-pillar approach. Pillar 1 seeks to reallocate profits of large companies to market countries. The initial threshold is set for groups of turnover of over 20 billion and profitability of greater than 10%. The second pillar, which is more advanced and therefore will be the focus of our session today, that aims to set a global minimum level of taxation. This global minimum tax is achieved via the Global Anti-Base Erosion Tax, or GLOBE as it's called, and is subject to tax rule. The GLOBE tax can be collected in one of three ways. Firstly, through a qualified domestic top-up tax, which is collected by the jurisdiction in which the profits arise. Next, through the income inclusion rule, collected by the ultimate parent entity, or finally via the undertaxed profits rule. Just to note that we generally refer to GLOBE and Pillar 2 interchangeably, as the GLOBE rules are a key component of Pillar 2 and are further developed than the subject to tax rule. There have been several key developments in recent months in relation to Pillar 2. As you are aware, the OECD released the GLOBE model rules in December 2021. These rules have not changed, but the OECD subsequently released commentary on the GLOBE rules and also some examples of how the rules should operate. The commentary stretches to over 200 pages and provides some additional assistance in understanding and interpreting the GLOBE rules. However, as Anna will expand on later on, there remains a lack of clarity on how these rules should apply in certain cases, and indeed the meaning of certain key words and phrases remains unclear. Given that these rules are to apply consistently across the world, there is a risk of differences in approach and interpretation by tax authorities. In this regard, it reminds me somewhat of the difficulties we all faced when applying DAC 6. It is hoped that further clarity will be provided in an additional document currently being developed by the OECD called the Implementation Framework. The aim of the implementation framework is to support tax authorities in the implementation and administration of the GLOBE rules. A public consultation recently closed on this framework and it is expected to be released later this year. Two important areas where we have not seen any further developments are the extent of the safe harbour provisions, which will hopefully reduce the administrative burden of the GLOBE rules on taxpayers, nor have there been any developments on the interaction of the Globe rules with the GILTI provisions in the US, which Brett will hopefully touch on later on. The OECD released an updated draft directive to implement the Pillar 2 Globe rules in March. This directive includes a number of changes from the draft release in December, primarily seeking to align it more closely to the OECD rules. One key difference remains, however, in that the EU directive will apply to wholly domestic groups, although there is now a transition period. One important change to point out is that the EU has effectively pushed the implementation date out by 1 year. The directive now provides that the Globe rules will apply to accounting periods beginning on or after 31 December 2023. This would be the effective date for the income inclusion rule, but as the UTPR is to apply a year later, the UTPR would then apply to accounting periods beginning on or after 31 December 2024. Another change is that as a concession to smaller member states, there is also now an optional carve-out from the Globe rules until 2029 for countries with no more than 12 ultimate parent entities based in that jurisdiction. This, of course, does not apply to Ireland. While the EU have pushed out the effective date, interestingly, the OECD have not yet made any official announcement on whether all jurisdictions should defer implementation of Pillar 2 by a year. Importantly, the directive requires unanimous approval by all EU member states, which has not yet been achieved due to resistance from Poland, and Vino will share some further insights on the political landscape in the EU and the path to ratification of the directive. If and when the directive is ratified, Ireland will need to introduce legislation to implement the Globe rules into Irish law. As a reminder, as previously communicated by the Minister for Finance, Ireland is committed to retaining its 12.5% tax rate for groups who are not within the scope of these rules, which is a welcome confirmation for the vast majority of businesses operating in Ireland. Now, based on the updated timeline of December 2023, it is expected that Ireland will introduce these rules as part of the budget process next year, that is, as part of Finance Act 2023. In this regard, the Irish Department of Finance released a consultation on the 26th of May to solicit the views of stakeholders on the implementation of the Pillar 2 rules into Irish law. These rules will have a significant impact for Ireland across fiscal, budgetary and industrial policies, and therefore requires careful consideration, and it deserves stakeholder engagement. The consultation will run until 22 July and it contains 25 questions. Naturally, Ireland cannot change the fundamentals of the Pillar 2 rules, but we do have some key decisions to make. A vital decision is whether or not Ireland should introduce a qualified domestic top-up tax. This top-up tax would ensure that in-scope companies operating in Ireland would pay an effective tax rate in Ireland of 15%. This should then result in no additional tax payable on those profits under the IIR or the UTPR. Well, I think it's safe to say that the general expectation is that Ireland should and will introduce such a top-up tax. The impact needs to be considered carefully. For example, a 12.5% statutory rate in conjunction with a qualified domestic top-up tax could result in certain deferred tax balances being booked at 12.5% rate for the Globe purposes. And therefore the release of such timing differences could result in a 2.5% top-up tax in order to achieve the 15% ETR. Many groups have prepared some modelling of the impact of these rules, and without this it's difficult to fully understand the implications of the Globe rules. The transition rules apply today and therefore need to be considered when undertaking transactions. It is also the case that the accounting standard which applies can result in different amounts of tax payable under the Globe rules, and I know Anna will touch on that later. Other important areas are how to treat tax incentives, with qualifying refundable tax credits receiving favourable treatment under the Globe calculation, whereas other tax incentives can instead reduce the covered tax in the ETR calculation. While ensuring that R&D tax credit in Ireland qualifies for this favourable treatment, I think this can be achieved with some small tweaks. There are bigger questions around the KDB, for example, and indeed the necessity for other forms of tax incentives in Ireland going forward. I mean, Ireland's stated aim to be agile from a tax perspective, I think will certainly be put to the test as jurisdictions worldwide fundamentally reform their tax incentive regimes. As a final point in the consultation, KPMG will submit a response in due course, and I would encourage you to get involved in the process. We are happy to take on board any comments you may have in relation to the consultation. It is expected that the Department of Finance will have further requests for input, including a feedback statement, before finalising the legislation on the Globe rules. Now, with that, I would like to bring in my colleague Brett Weaver. As I mentioned, Brett is a tax partner with KPMG US. Brett, I know you've been leading the charge on the impact of the BEPS 2 rules for a number of US multinationals, and indeed you've spoken to government authorities, including the Irish Department of Finance, on these matters. It's clear that the progress over the last year would not have been possible without the strong support of the Biden administration, and in particular the groundwork put in by Secretary Yellen. However, it's a whole different ballgame to get tax reform through the US Senate, which is, as we know, currently split 50-50 between Democrats and Republicans. So Brett, I might firstly ask you to give us a sense of the tax reform landscape in the US and how it links in with the BEPS 2 process, maybe in particular mentioning GILTI and how that would interact with GLOBE. And then finally, perhaps you might give us a brief update on Pillar 1 and your sense of the likely outcome there.
Sounds great. Yeah, thanks, Killian, and great to be with you today. Let's jump into the U.S. tax reform landscape. You hit the nail on the head, Killian. That Janet Yellen, leading U.S. Treasury, has been a strong advocate for both Pillar 1 and Pillar 2, and has played a pivotal role in getting it to the point where it is now. As everyone knows, right, the Democratic Party controls all three branches of the U.S. government. And so we would think with that in play and the strong support for these global reforms from President Biden and from Treasury Secretary Yellen, that we would be able to push both Pillar 1 and Pillar 2 through our legislative process. But as you've highlighted, that's not the case. And there's a number of reasons for that, and maybe just a little bit of background, right? It's even though they control, right, the Senate is the biggest issue, and that we have an even split there, 50-50. That tiebreaker is actually broken by the vice president, Kamala Harris, right, which you'd think would vote, for whatever the Democratic policy is. But the tax reforms that the administration has put forward to this point have been fairly significant in terms of raising taxes, including adopting a lot of, not all of, but a lot of the Pillar 2 type proposals. It's that raising taxes has been an issue, as well as some of the spending proposals that have been attached to those tax bills. So the level of taxes that are being proposed to be raised, and again, this goes well beyond Pillar 2, as well as the spending that's attached to that, has caused some of the Democratic senators to balk at these proposals, and therefore have not received the full support that's needed to get to that tiebreaker perspective. So that's what's held it up to date. And even though there's still time in the U.S., technically speaking, and there's some procedures that the Democratic Party could use to get things through the Senate right at that 50-50, they still need everyone to support it. And the problem with, even though there's time, right, and from my own estimation, maybe we can get out to the end of July or so to see some tax reform move through the U.S. process this year. But as a practical matter, there's so many other things that are taking the attention of Congress in the U.S. right now, that the likelihood of these types of reforms getting enough attention to actually get pushed through, and they'd really have to be pushed because we're at this 50-50 level in the Senate. There's just too much other things going on. Most notably, the biggest issue facing the administration right now is inflation in the United States, which is really going stronger than we've seen it in 20 plus years. A lot of concern about other issues, particularly supply chain, right, the war in Ukraine, et cetera. And so there's just so many other things on Congress's agenda that the likelihood of this, getting pushed through, within the next several months is difficult. And once we get past that point in time, for those of you who are not following U.S. politics, right, we have our midterm elections that will be coming up. Those will be held this November. And that's why I say toward the end of July, because we would start to see Congress then pivoting toward their efforts moving forward to that midterm election. And everyone will be focused on midterm elections at that point. And if there is concern that the Democratic Party loses their control of even one of those legislative branches, right, the House or the Senate, then all bets are off. There's not a lot of support for either Pillar 1 or Pillar 2. I can talk more about that from the Republican Party, currently the minority party, and so that would make it even more difficult. So, Killian, anyway, I could go on, but hopefully that gives a good sense as to what's happening in the U.S.
Just on the Pillar 1 proposals, Brett, what's your sense of where that sits at an overall OECD level and the chances of introduction or success?
Yeah, I think there's a lot of progress that is being made at the inclusive framework level, led by the OECD. As you mentioned, we've had a lot of discussions both at the secretariat level as well as a number of the governments that are really driving the development of these rules. As we all are aware, the progress has been significantly slowed from the targets that were set out late last year, and we continue to see consultation papers, coming out in dribs and drabs, and later than was expected. But nevertheless, I mean, these are complicated rules, and we are seeing some progress, being made in the development of the Pillar 1 rules. So I think that's moving honestly about as fast as it can. I think there's a dose of reality that some of the original targets were really aspirational, and that needed to be readjusted. And I think I know we're seeing that happen. So I think that work will continue to move forward, and I think that a lot of this work will matter, even if we don't get Pillar 1 enacted across the world. And I think it largely does depend on the US, my own view, right? Whether the US adopts these rules will be dependent upon whether they just generally happen. You have to have the US on board for Pillar 1, I think. It's not the case for Pillar 2. But I think they'll matter even if Pillar 1 is not adopted right off the bat here, because these proposals tend to be picked up again down the road, with another relook at these issues. These proposals could find their way, elements of them, into other rules that are adopted in countries around the world. And I'm sure Vino could talk more about that. So they do matter in that sense. And that's why a lot of US companies have been engaged in the process, even though there's an expectation, and I share this, that Pillar 1 is not going to be adopted in the near term, at least in the US. And that goes back to a lot of what I mentioned earlier. Just there's so many other things on the domestic agenda in the US that global tax reform is probably just not going to get any attention before the midterm elections. And I would also add that even though the Biden administration has been very supportive of both Pillar 1 and Pillar 2. The Biden administration has only proposed legislative changes around Pillar 2. There's never been a proposal for domestic legislation in the U.S. around Pillar 1 at this point. So it's definitely well behind Pillar 2. And it's just so nascent in its development and even gaining attention in the legislative process in the U.S. that I don't see it happening anytime soon.
Thanks, Brett, for now. We'll bring you back in later on for a panel discussion. Appreciate your views and thoughts. I would now like to introduce my colleague, Vino. As mentioned, Vino is Head of Tax Policy for KPMG in EMA. Vino, the EU has been very active in the tax policy front. Can I ask you perhaps to expand on my initial comments about developments of the Pillar 2 rules within the EU, and then to touch on some of the other key developments at European level that you were speaking to clients about?
Thanks a lot, Killian. Here again in 2022, we see that we have an over-ambitious European Commission and EU Council that have taken the BEPS 2.0 agenda and expanded it, not only on substantive tax provisions, but also in the field of transparency. And I will not go into the details of all of them, but I would like to flag here, for example, EU country by country reporting on a public basis. It has been adopted after 5-6 years of negotiation in the Council, so we see a further step in mandatory public transparency of multinational companies. And I know Brett will address this issue later on as well. So all EU member states now have basically more or less a year to implement this EU directive into domestic legislation. And then 1 year later, in June 2024, it will become effective. And for most jurisdictions, this means financial year 2025 is covered as the first reporting year. Very important to note. And many of our clients are currently doing a test drive or doing pilot sessions for previous years just to see what it looks like, and perhaps even also to include a certain narrative if the public outcome might raise some questions. Apart from all of these initiatives that the European Commission is looking at here, I would like to also flag at this point in time some other tax-related measures that are not on this slide, but where the European Commission is also taking significant steps. And I'm thinking about anti-money laundering. I'm thinking about the EU regulation that is very close to being adopted about foreign subsidies, which could potentially lead to the mandate for the European Commission to investigate tax subsidies granted by non-EU countries, for example, China, when they want to acquire an EU asset. And the EU thinking behind these rules is that, of course, these tax subsidies could lead to an unlevel playing field when it comes to acquiring EU assets. So I would definitely watch the wider scope of the EU developments, slightly broader and adjacent to tax. As Brett has mentioned before, on Pillar 1, we see a certain delay because of the complexities of the rules and the legislation. And also on Pillar 2, we see that EU member states already flagged the issue of timing. In the Pillar 2 directive, there was the original starting date for the IIR of 1st of Jan 2023. And Sweden, supported by 7 or 8 other EU member states in the course of the negotiation of the EU Pillar 2 directive, have mentioned they cannot meet that deadline. So in the current Pillar 2 directive of the European Commission proposal, it now has a 1-year delay, which means an effective starting date of the IIR of 1st of Jan 2024 and 1 year later for the UTPR. And if you look at the current compromise text that is on the table, that is still not being adopted because of this one outstanding vote of Poland, is that it very closely follows the OECD model rules and the commentary, and where possible also refers to the OECD model rules and commentary for further interpretation. And for all the elements that will be included in the implementation framework that will be launched in the 3rd quarter, I assume, of 2022, also there the EU is hinting at following the OECD rules and need to be included in the interpretation and domestic legislation by making a very cross-the-board reference to OECD documents. One element that is very important here is that in the EU Pillar 2 directive, there's also an opening for the OECD to come up with a certain methodology to take into account, for example, US guilty if it's not being amended according to Pillar 2 rules. So the EU is already working on the assumption that perhaps the US will not be able to amend its regime, and therefore these taxes for some under a certain rule could be qualified as CFC taxes that can be taken into account as cover taxes of constituent entities in the EU jurisdiction. So very important topic, I think. Also on Pillar 1, the EU is working under certain scenarios, right? We have seen that when it comes to unilateral DST measures, that some of the EU member states have been on the forefront of these developments, keeping in mind that it was basically some of the larger EU member states that have started to push for taxation of the digital economy. The US position was, of course, we cannot ring fence the digital economy, and therefore many EU jurisdictions started to implement or enact DST rules as a pressure point for developing Pillar 1 solutions. And there is currently already certain scenarios being discussed with the European Commissioner. What happens if by the end of 2023 or in the course of perhaps 24, it becomes apparent that Pillar 1 will not fly? And there we see very muddy waters. Some jurisdictions feel that they can keep their unilateral DSTs, and therefore that's the appropriate way forward. The EU Commission is slightly more hesitant because, of course, we have this US Section 301 trade investigations and decisions claiming that there's discriminatory treatment of US companies under these DSTs. And there is already a current proposal by the European Commission, and it was publicly mentioned, that they're thinking of a potential digital levy that could replace all these unilateral measures. And the digital levy could then, for example, have a very broad base covering all online sales of goods and services and a very low rate of potentially 0.3%. And that could potentially avoid Section 301 scrutiny because it has a broad base predominantly covering EU headquartered companies and not only US headquartered companies. So these scenarios will all play out in the course of 2023 and 24, but very important to monitor this development. Another element very high on the European agenda is EU shell entities. In the eyes of the Commission, there are still possibilities that shell entities with low or no economic substance have obtained certain tax benefits. And the outside world, including KPMG, in the context of public consultations, have mentioned we are already in the process of introducing principal purpose test, the GAR principle in EU directives. We have the concept of core income generating activities under BEPS action item 5 for preferential regimes. So why not wait and see the actual effects of all these rules before we add on another layer of shell entities? But the Commission didn't want to wait. And here in this slide, you see a certain flow chart how that effectively works. It starts with a self-assessment and then a reporting obligation and then an effective exchange of information on a mandatory basis between the EU member states. I just want to share here with the audience that the EU Council negotiations started in April on this topic. The French presidency first started negotiations on Pillar 2 and focused all their energy on that. And the shell entities were basically placed a little bit in the backseat of the Council negotiations. But preliminary statements from the Council raise very critical questions from the EU member states to the European Commission on why we need this, why do we need it in this form, how does it interact with CFC rules, how does it interact with the GAR principle, and all kinds of technicalities related to the procedure and the mechanics of the directive. So my understanding is that we will not see an adoption of the directive in the near future, given the very critical responses of the EU member states. A few words about the EU DEBRA proposal. Maybe some of you still remember that in the EU CCTB proposal from a few years ago that has currently been shelved, there was one element which was called the allowance for growth and investment, which effectively allowed a notional interest deduction on equity. Currently, 6 or 7 EU member states have such a notional interest deduction, and the Commission felt that it would be appropriate to add that to the CCTB. In 2021, when the Commission launched its communication on business taxation for the 21st century, the Commission felt that there was too much bad news for multinationals, so they wanted to add on a certain cherry on the pie as well, which was the notional interest deduction. And this notional interest deduction was then basically copy-pasted from the CCTB proposal and then launched as a separate proposal. But when the Commission made a small tour de table of EU member states, many member states did not want to support an approach like that because it would be costly from a budget perspective, and therefore many member states didn't want to adopt this. So what we see now is that the Commission very cleverly has added a new provision to this proposal, which is basically a 15% limitation of interest deductibility for the net of interest paid minus interest received. And this interest deduction limitation will be on top of the 30% EBITDA that is currently already part of ATAT. This significantly complicates matters, but it would lead to a budget neutral situation for EU member states. And I think that's, Kilian, for me, the EU overview.
Great. Thank you, Vino. So with that, I now hand over to Anna to expand on some of the common issues that we are encountering with the Globe rules and to lead a panel discussion.
Thanks, Kilian. As we worked through the model rules and the related guidance and applied them to specific client scenarios, we have encountered a number of issues and outcomes that one might not necessarily expect. I've highlighted a few of them here on the slide. Firstly, there appears to be a potential for differing outcomes depending on the accounting standards applied by groups, whether US GAAP or IFRS, for example. And some interesting results can arise where there have been historic intra-group transfers of IP and other non-inventory assets. While the guidance and indeed the expected intent of the model rules was that any step up in value in IP is respected in respect of past transactions, that may not be as clear-cut as we had hoped, and there may be some differing ways of interpreting the model rules in this area. What is or isn't a covered tax and how it's measured is also open to interpretation. For example, the rate at which deferred tax assets are taken into consideration in determining covered taxes for the purposes of GLOBE will likely come down to how or if countries implement a domestic top-up tax, and whether that top-up tax will be a qualified domestic top-up tax, which is obviously yet to be determined. Brett mentioned GILTI earlier, and we'll come back to that, but assuming the US don't come on board or aren't able to come on board, and GILTI is considered a qualifying CFC tax, will lower tier subsidiaries grant relief for GILTI in calculating any domestic minimum top-up tax? And if so, how is GILTI going to be allocated in those circumstances? And don't forget that while the effective date of the provisions might be kicked out from a European perspective, at least to accounting periods beginning on or after 31 December 2023, the transition year rules are already in place since November 30th, 2021, and will likely be in place longer than we ever anticipated, which is causing many companies to have to rethink their IP strategies and how they implement and affect certain time-sensitive commercial transactions. There's also a distinct risk that we'll have to deal with a number of different implementation dates. And while we await for further guidance on a number of areas, will that guidance be clear enough? And will the rules be capable of being implemented consistently? To deal with some of the questions many of us have, let me bring Brett and Vino back into the conversation. I'd like to cover Pillar 2 a little bit. You alluded to the difficulties at US level to making any legislative changes. Can you firstly remind us what would be required to bring GILTI in line with the Pillar 2 provisions? And do you see any viable path for the US to be able to implement Pillar 2?
Yeah, that's a great question. Getting into the details of adopting Pillar 2 in the U.S., GILTI is a centerpiece of that, without a doubt, as you've alluded to. And what would be required, right? The big fixes would be primarily to change GILTI from its current approach, which is global blending or global jurisdictional blending, and moving that to a country by country jurisdictional blending. And so that's the big change, right? I don't think there was ever a view that that the U.S. would completely conform to the model rules for an IIR. And so the big change is really making sure that the rate, right, was essentially at 15% and going to country by country. There was a lot of support, from business for that before December. Right. In December, when the model rules came out, there was a surprise, at least to most U.S. companies in there, right? And that was moving the qualified domestic minimum top-up tax to the first of the line in the order of priority. I think a lot of U.S. multinationals were thinking that if they got a GILTI fix, they could really forget about Pillar 2 for all of their affiliates right around the world. You still have a Pillar 2 issue to address in the U.S. Well, with this change in the December model rules, that's out the window. Right. And so I think a lot of U.S. business is looking at, the prospect of a GILTI change is they don't get anything in exchange. Right. And quite frankly, existing GILTI on a global blending is a little bit, and in some cases, a lot more favorable to U.S. business than is moving to a country by country jurisdictional blending basis. And so if there's no upside in modifying GILTI to conform, for business, but there's a lot of upside in leaving it the way it is, that's one of the big concerns of ever getting, GILTI to conform, is it's lost the support of business in the U.S. And Anna, put one other, comment in there, again, besides the political issues that will make it, difficult for the U.S. to push this through this year anyway. The business support is a key aspect of keeping, all of the Democrats in line to support this. And as more and more the details of Pillar 2 have come out, I think it's really, it's eroding U.S. business support. And examples of that, you kind of alluded to this, Anna, in terms of Is there a bias to IFRS versus GAAP? I think you work through some of those rules. Some US companies think that the way GAAP applies in that context is disadvantaged compared to IFRS. The US tax system very heavily relies on foreign tax credits. We have the check the box rules that can create hybrids, et cetera. The Model 2 rules seem to disadvantage US companies, both in terms of heavy reliance on credits, the check the box rules, et cetera. So that's just a broader scope as well in terms of concerns that U.S. business has in supporting this, and that's really important, I think, in getting Pillar 2 completed and actually passed in the U.S.
And Brett, notwithstanding those concerns that you've alluded to there that multinational groups might be having, many of them are actually very focused on Pillar 2, and they are focused on doing modelling or scenario analysis. In your experience, where are they spending their time in this whole area?
You hit the nail on the head. And U.S. multinationals sort of the view, generally speaking, right, Pillar 2 is going to happen, right? Even if the U.S. doesn't act, as we've talked about, it will happen. So it's a reality they're going to have to deal with. And so they are very concerned. They're very focused. A lot of the issues I just mentioned, many U.S. multinationals are involved in the development of the existing framework to try and fix, let's call it, right, some of these concerns. And so we do see U.S. multinationals very much involved in the development of, I don't know, I call it the commentary to the commentary, right, that we're working on now under Pillar 2, right, to try and address some of these fixes. And we've seen some progress in some of the things that officials have mentioned here lately that are attractive to U.S. multinationals that look like a bit of a fix, right? So there is this advocacy in developing, the final rules here. But probably the biggest area of focus for companies right now is really trying to model the impact of Pillar 2 on, U.S. multinationals. And that's primarily, looking at the complexity, right, of the Pillar 2 ETR calc on a, jurisdiction by jurisdiction basis. And as I mentioned, there's, a number of these rules that have caught, I think, all companies, but including U.S. multinationals by surprise. I think there's a going in expectation that, the U.S. has a 21% rate. How could it ever be, hit with a top-up tax of any sort? And I think as we start to work through the labyrinth of rules that we have under Pillar 2, there's a lot of surprises in there, right? I mean, things such as resizing deferreds from the 21% rate in the U.S. to 15, right? The unfavorable, as most U.S. multinationals look at it, treatment of foreign tax credits. Most of the U.S. credit systems, are not refundable credits, right? They are non-refundable credits, which seem to have a negative impact in that ETR calculation. We could go on and on with the list, but there's a lot of surprises. In fact, I would say at this point, and again, there's a lot of uncertainty around how these rules are working out, but companies that we're looking at, and again, we might be taking more of a pessimistic view on some of the unsettled questions, but I would say about 2 out of 5 companies are finding that, their US rate is going to fail the Pillar 2 15% ETR calculation. And that's incredibly surprising. And one of the reasons I mentioned that we might see a loss of US business support in where this is going. I think business is on board with the notion 15% is fair. But I think the way these rules are shaking out is very surprising to some companies. And so that modeling effort is very critical. And most companies are on that task right now.
And no surprise, I mean, clearly tax departments are already pretty stretched dealing with the level of compliance that they have to deal with now. This is going to impose a significant burden on tax teams and going to make them have to work even harder with their colleagues on the financial reporting side of things. So I know that is certainly something that we are working very closely with our clients on as well and supporting them in their efforts. Okay, a quick one, Vino. Despite their very best efforts, I know the French presidency has struggled to get Pillar 2 over the line. As you mentioned earlier, the Czech Republic will actually take on the presidency of the European Council very shortly. Do you think enough will have been done to get Poland on board so that the EU directive will indeed be accepted by all?
That's a very good question, Anna. I think first, I think we have to give credits to the French presidency, right? Maybe 30 years ago, it would take on average 10 years to get an EU directive adopted in the EU Council. And the French almost came very close, right? Just one vote missing at the latest ECOFIN. I think the French have been very clever in the way they approach the Council on the directives, because in the January 2022 first Council meetings, there were still 9 member states not on board of the Pillar 2 directive. So they've gradually taken the concerns of some of these jurisdictions and included them on board of the Pillar 2 directive, or in the opening recitals, or perhaps even in political statements related to the Pillar 2 directive. Poland continues to make the claim that there needs to be a legal link between Pillar 1 effective implementation and Pillar 2 effective implementation. The Polish delegation continues to state it was a package deal. We cannot just have Pillar 2 and forget all about Pillar 1, which to many of us seemed surprising, because the Polish delegation in the past were not so adamant on this specific point. So many also in the press have wondered whether maybe there are other issues at stake here. In short, maybe you've seen that there's a significant dispute between the EU institutions and Poland related to the rule of law. In a nutshell, the EU institutions find that the Polish current government has eroded the independence of the judiciary. And because of that, and the non-compliance of the Polish government related to ECJ infringement cases has led to penalties and a blocking of EU COVID support funding to an amount of 35 billion euro. And in recent weeks, there seems to be some sort of unlocking of that deadlock. The Polish Prime Minister came out and said, we are on a solution course. We have an agreement with the European Commission. We will amend something about our judiciary, and then we will receive EU funding. Just last week, the European Commission came out and said, we've got an agreement, but under 3 conditions. And the 3 conditions need to be enacted into Polish law before 1st of July 2022. And that has not happened yet. That means to me that the 17 June ECOFIN that the French presidency is aiming for an adoption, it's possible, but I would say it's more likely during the Czech presidency, because then we would have this deadline, right, the 1st of July 2022, that the European Commission can effectively monitor and assess if Poland did change their rules related to a judiciary disciplinary chamber. And on top of that, maybe you've seen in the press, there have been some harsh words between the Polish Prime Minister and the French President related to the Russia-Ukraine situation. So I think the diplomatic momentum between the French and the Polish is not really there.
Okay, thank you, Vino. And I have 2 very quick questions, and the answers are yes, no, or maybe, okay? And the 2 questions are, 1, the European draft directive has essentially pushed the implementation of Pillar 2 out by a year. Do you believe this revised deadline will be met? Yes, no, or maybe?
Yes.
Yes, okay. And 2, could you see the European Union move ahead with Pillar 2 implementation before the rules are implemented globally? Yes, no, or maybe? Yes.
Clearly, yes.
Interesting, because certainly they are questions that we are being asked all of the time. And I think everybody will find your responses very interesting there, and a lot to think about. Public country-by-country reporting, you touched on earlier. Have any other countries made the move to introduce their rules already?
In the EU jurisdictions, no one has made a move currently. So an EU directive is, of course, a minimum standard. So member states are allowed to go further than the directive and go quicker than the directive implementation deadlines. But on this specific topic, we have not seen any movement of EU member states.
And on DEBRA, you mentioned in your slides earlier, those proposals seem a little counterintuitive in the context of introducing the global minimum effective tax rate. In your view, what's the likelihood that these proposals would be ratified?
I think the likelihood is, I would say, below 30%. The member states did not ask for this proposal. It's a European Commission invention. The Commission felt they wanted to do something in favor of the business community, but because the EU member states did not ask for it, I don't think it will be adopted very soon.
Okay, thank you. And the last one, if we don't get much further on Pillar 1, and clearly it's well behind the Pillar 2 proposals, and we do continue with the proliferation of DSTs, do you really think the EU will introduce their proposed levy?
I think the European Commission is almost obliged to continue with the digital levy. Maybe you remember that in the context of the COVID support funding, where the EU has launched EU COVID bonds to an amount of 750 billion euro to the capital markets, and that has a repayment plan of the next 30 years. And the Pillar 1 revenue of the EU member states was allocated to plug, I think, 5 or 6 billion euro per year on that COVID repayment plan. If that Pillar 1 revenue is not there, the Commission already publicly stated we need an EU digital levy to plug that gap for the next 30 years. And that is on top of the reasoning that the EU Commission feels that the unilateral DSTs are not sustainable given the US position on Section 301. And a digital levy could potentially be the way forward.
Tax incentives are an area which will clearly be a focus for all jurisdictions and businesses under the Pillar 2 rules. What changes do you expect to see in this area?
In an EU context, that's very difficult to predict. Currently, we have no indication, right? We've seen non-EU member states, non-EU states like Switzerland, Singapore, and some other jurisdictions started consultations about this topic. But in the EU, of course, it's a slightly more different context because we have very strict EU state aid rules. So I would say the room for maneuver is rather limited in an EU context, Anna.
Okay, thank you. And Brett, just shifting gears for a moment to another very important topic. I know that you have taken a leading role here in KPMG in growing the area around ESG and tax transparency. What are you seeing in-house tax leaders do in this space? And what is your sense of how it interacts with the BEPS 2 agenda?
Yeah, that's a great question, Anna. And I think a lot of VPs of tax are really contemplating that question, right? How does all this work together? And I do think there is some interaction, right? I mean, what we're seeing, one, I think, as we all know, Europe has been ahead in this space, I think, as compared to the US. But I think that gap is closing quickly. If we look back just 18 months ago, we do regular surveys of US multinationals. Less than 30% of US multinationals had published a global tax strategy or planned to publish one. That's just 18 months ago. In our most recent surveys, it's over 70%. So, we're seeing that change, very quickly. And so one of the outcomes that we're seeing from that with, greater transparency here as companies start to discuss in a public forum their values around tax, their approach to tax, that they are taking a harder look at their governance and controls. And these are not financial controls, right? These are controls that are designed to assist in the decision making and ensure that they understand the company understands where that tax risk appetite is, and that decisions are made in accordance to that. I think that's ensuring that more and more companies are doing tax planning in a way that's supportive of the business and is aligned with where the business is going. And I think most companies are there, but I think there's a sharper focus on that, right? And we're seeing more and more companies come into that. I think that will only be enhanced by the country by country reporting directive that you and Vino mentioned, right? Certainly, U.S. multinationals will be subject to that as well. And so I do think all this is coming together. One thing that I think it would be remiss in not mentioning as well is that, the stakeholder, desire for this type of disclosures around behavior and approach to tax and more transparency around payments, that's growing significantly across the globe, but also in the US, right? We had just last month in May, one of the more prominent, U.S. multinationals, had a shareholder resolution vote that would mandate that the company do country by country reporting. And so, that ultimately failed this time, right? But we will see that happen more and more with U.S. multinationals. So it's not just what the regulators are doing, right? I think there's other stakeholder pressures out there that we're seeing tax departments really need to be ahead of the game and understand and have a very cohesive approach around their approach to tax and be much more transparent about it and be very comfortable in the positions that they're taking.
And to finish up with you, Brett, IDA Ireland, which is the inward investment agency here in Ireland, has just had one of its best years in terms of attracting US companies to come to Ireland and continue to invest here. From your discussions with your clients, how do you think Ireland is positioned in terms of continuing to be an attractive place for US companies to invest?
Yeah, that's a great question as well. I think it ties back into the prior discussion we just had, right? That more and more tax planning is supporting the business, right? And I think that's why Ireland remains very attractive to US multinationals, is because it's a great place to do business, right? There's a highly educated workforce, very stable economy, rule of law, et cetera, right? These things are all critically important as decisions are being made as it regards significant investments to grow the business, et cetera. And the fact that there are relatively favorable tax rules, right, that the Irish government has clearly been committed to consistency in their approach to the tax rules, that's incredibly important to the C-suite, right? Not just the tax department. And so I think the fact that that Ireland remains committed to its approach to tax, and essentially the 15% rate for large multinationals that would come into play there, it's an important factor, right? So tax will always be an important factor in terms of where to locate significant investments. And even though I think maybe some of the accusations that tax was the driver in the good old days, right? I think some of us would say that wasn't necessarily true anyway, but clearly those days are behind us. Tax will remain important, but business will drive it. And in that regard, Ireland is well situated across the board on all of that criteria.
Thanks, Brett. So before handing back to Killian, it's clear that there are many changes ahead, and the changes may have a significant impact on effective tax rate and tax policy decisions that groups will make. There'll be a difference in timing between how some of these changes are implemented. Countries are also likely to introduce new incentives and other ways to compete, and it's going to have an impact on tax departments and how they are resourced and supported. And critically, notwithstanding the time frame for implementation may have been pushed out, at least at EU level, it's critically important that companies and groups start to understand the impact that these changes are going to have on their own specific facts and circumstances.
Thanks, Anna, and to Brett and Vino for your fascinating insights. Certainly plenty to chew on, and a number of pitfalls to be aware of that could impact transactions being carried out today. There is no doubt that it's important to engage with these rules now and to consider the implications for your business. I hope you found today's session insightful, and will endeavour to keep you up to date on future developments as they arise. Please do let us know if you have any feedback on today's session. So thank you for joining us. Please feel free to reach out to us or to your usual KPMG contact in relation to the consultation or any of the queries that you may have.